Top of the day to you. This is Drew Stevens with a very quick episode on wisdom to wealth to help you to understand a little bit what occurred last evening, and I'll get to that momentarily here, and what it means to your future. What happened last evening? We had a State of the Union. It was probably one of the longest and, more importantly, the most delayed State of the Unions with which in the history of the United States is not pretty apropos. But I want to put politics aside, and that's not exactly what this presentation is about for you. It was something that was said and was not said within the construct of the State of the Union that as financial advisors and as certified public accountants, I need you all to understand. And that is simply this. What was mentioned last night is that if, in fact, Biden remains as president, then there is a possibility of him going after corporate tax rates and raising corporations' tax rates. Now, I don't want you to be fearful of that because not a lot of time was spent on not only corporate tax rates, it was less than 10 minutes, but there was no mention about marginal tax rates. Secure.0, as I call it, was signed into law by Obama way back in 2017, extended by President Trump in 2020 due to the effects of COVID, and soon to now be deadlined December 31st of 2025. What does this mean to you? What does this mean to your clients? Well, in less than 10 minutes, and most importantly, in the next year and a half, all of your clients, you and I, anybody over the age of 60, should be increasingly concerned because by the time they turn 73, then they're going to have to pay required minimum distributions. And those required minimum distributions are based upon actuarial charts as to your mortality, your client's mortality, and any of the savings that they still have that have not been taxed at this particular point in time. There's a very famous individual by the name of Ed Slott that talks a lot about the retirement tax bomb. Yeah, you and I as children, I'm 62 and I was just turned 62 and about 6 weeks ago. And what we were always told as kids and as young adults growing up is that as we work in major corporations, it's smart to go ahead and take some of that money and put it away for retirement. Nothing wrong with putting away that money for retirement. But what they forgot to tell us about is that if we didn't touch it, what they forgot to tell us about that when it's sitting in an account or a series of accounts for a number of years, 20, 30, 40, 45 years, that's 45 years worth of gains, 45 years worth of taxes that we now have to start paying out. And here's the problem. When we have to start paying required minimum distributions, do you know when you pay your taxes and sometimes you forget to mail in the full amount that's due, or you don't have that money and you ask for an extension, but the IRS manages to send you those nasty grams of both penalties and interest, and this is what you owe and when you owe it? They're not going to do that for required minimum distributions. No, 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 no. You will have a year after your birthday up to that tax date to start paying those RMDs. And if you forget about it, there's going to be a penalty. And it could be a serious penalty depending upon how much you have stored up in that account. So why am I having this conversation with you? It's very important, and it really occurred out of the conversation last evening, and that is simply this. Marginal tax rates as we know them are set to expire December 31st of 2025. Which means that the 37% marginal tax rate that we have here in the United States could potentially end. Now, what that simply means is it's going to move up by about 3 points. That's it. That's not terrible. But what we don't know is with a vote and the stroke of a pen within the next 5 or 10 years, those marginal tax rates could increase to 40, 50, 60, 90%. We just don't know what that is. What we know for a fact is simply this. We have an incredible trade deficit. We also happen to have $34 trillion worth of debt here in the United States. And at some particular point, Congress and any president is going to do what they normally do, and that's go back to the shareholders, all of us, the taxpayers, and say, you know what? We're going to have to raise taxes. As I start looking in the local papers around where I live and work, and I talk to friends all around the United States, municipalities are cutting back on certain programs because there's just not enough money to go around. Budgets are just ridiculous. They're falling apart piece by piece. We have had several government shutdowns. We could potentially have another government shutdown simply because budgets are just all over the map. And at some particular point, with all of this debt, there's no one else to return to but to the taxpayer. What I'm telling you to do as a CPA, as a financial representative, is start having those conversations with your clients. Because here's the thing. If you're not having these tax efficient conversations with your clients, three things really are going to be effective. Number one, you're doing a disservice to the client in and of itself, because the client needs to be aware of what the marginal tax rates are and how that's going to harm them as they need to start getting prepared for that retirement timeline, and most importantly, required minimum distributions. Number two is simply the fact that at some particular point in time, it's going to be necessary to create a retirement income strategy for these individuals. And if you're not talking to them about tax efficiencies and tax effectiveness, it's going to rain on them in a bad way, because they're going to have years of income taxes that they're going to have to pay. And there is that fear that with the taxes, they may wind up running out of retirement income. That's right. They will outlive any income that they have in retirement. And third, and this goes specifically for accountants, CPAs, and even financial advisors, because I do this with my clients, and that is look at what the income base is. Because as they do and consider Roth conversions, which is what I'm leaning to for you, is simply this. You want to watch what that marginal tax rate is, because at some particular point, if it's too high, it may wind up setting off an IRMA penalty. And at that particular point, a person is now paying double for premiums, and you don't want to do that. So what are the things that I suggest for you? Number one, start talking to your clients about these marginal tax rates and see if perhaps you can educate them on taking those Roth conversions now, sooner rather than later. Three, stay close to the vest and find out what Washington is doing with these marginal tax rates, because it is a conversation we're going to want to have for the next 18 months until we truly understand whether or not these rates are going to sunset. And last but not least, start working with your clients to understand Medicare and what Medicare and IRMA is all about. Because if you're not, again, it goes back to the whole notion of disservice. When I look at talking with clients, it's really about one, Social Security and optimizing Social Security so that they can gain the most out of their benefit. Two, looking at tax rates and understanding what that optimization strategy is going to do with those tax rates, because there might be a way to hold off on taking the benefit too early and in concert work with a Roth conversion first. And third, if you're taking out too much money, you want to be very cautious because it could set up an IRMA penalty. Now, it could lead to no more than another $2,200, maybe $2,500 a year, which is not much when you have a very large tax bill of, say, $20,000. But you want to try to work with your clients to get an understanding of how to work with them on navigating the uncharted waters of retirement. It gets pretty, it's like traveling in a tempest, as they say. Sorry to struggle with those words, but it is. It's like traveling in a tempest. And at that particular point in time, what you want to try to do is help your client to navigate the narrow channels of retirement so that they can sunset into retirement safely, securely, and without anxiety. I look forward to talking to you soon on another one of these episodes. Have a great rest of your day.